Good afternoon, Josh. Officials believe during their December policy meeting that interest rates were likely at or near the peak for the current rate tightening cycle, and almost all participants felt that rates could end 2024 lower given progress on inflation. Now, even though almost all thought that rates could end the year lower, they stressed there's a lot of uncertainty around that, and that the economy could evolve in a way that would cause them to actually increase rates. Many said that an easing in financial conditions beyond what was appropriate could make it more difficult for the Fed to reach their 2% goal. And ahead of these minutes, we saw a lot of divergence in opinions from several Fed officials after Fed Chair Powell made that dovish pivot. And we saw evidence of that in these minutes. Specifically, several said that the economy or inflation might evolve in a way that will require them to hold rates at the current level for longer than expected, while some warned about the risks of being restrictive for too long. Now, one thing that everybody agreed on, clear progress has been made on inflation, but they still needed to see more evidence that inflation is moving back towards their 2% goal. They don't think that there are risks to the upside, but there is a risk that inflation could stall. Now, I do want to point out that Fed officials underscored that they're looking at the 6-month measure on inflation readings. And that's very interesting because if you looked at the most recent read on the Fed's favorite inflation gauge, core PCE, on a 6-month annualized basis, that actually clocked in at 1.9%, so a tenth of a point below the Fed's 2% target. So officials very much paying attention to that metric there. So bottom line here, guys, it does look like rates are moving lower possibly this year, but there's significant uncertainty around that forecast and outlook. It's really going to depend on how the economy evolves.